Welcome to the Samuele Tini Show, where business, innovation, and sustainability converge to drive progress. Are you ready to uncover solutions shaping our future? Let's dive in.
Welcome to a new episode. Today, we are going to discuss the world of private equity, and we are going to discuss one important question. Is it possible to do good, but also do well? I mean, it's a question that many ask along the years, and we do it today with somebody that's betting on the new markets, on the market that they are growing. So we are doing it with Nick Mwai, who is the founder and CEO of Pumapa Capital. Thank you so much, Nicholas, for being here with us today.
Samuele, it's nice to be chatting with you, and thank you for bringing me onto the podcast and share our journey with you.
Nick, you have been a business eye, you have been in transformation, you have been in equity all your life. But before going into the question that we put at the beginning, we want to know a bit, what is your personal journey? How you have entered this world of equity and capital?
Yeah, so I started my journey in the investment banking world, primarily in corporate finance, supporting large blue chip companies in Kenya and East Africa. And so I did that for about 7 years in Kenya. It was very eye-opening. I think what led me to start Pumapa was the journey I took after leaving that firm. I was with a startup for about a year, and they had a decent amount of funding, but I think there was a lot of lack of management systems in the company previous, which had led a lot of theft taking place. And so I joined trying to see if there was a rescue that could be done. But in that journey, I think I spoke to probably about 30 or 40 private equity funds within Kenya and throughout the world. And the product that we were doing was kind of a no-brainer. It was tackling low-income housing. It was tackling sustainable and affordable construction. But it seemed that most of the PE firms weren't very interested in investing in an impactful type of business of this nature. So I saw a lot of doors shut very quickly with no response, with no feedback, with no engagement, not even a conversation. And to me, that seemed a bit interesting that you have some of the largest investment firms in the world proclaiming to be a champion for investing in Africa, not even thinking about a solution that would double Kenya's housing market within 5 years. So to me, that seemed a bit interesting, that a conversation wasn't even a possibility. And so I thought, well, if they're not going to do it, then I will. And that's when I started Pumapa. And I said, we're going to fill this massive gap that all these international firms aren't filling. I think I've heard on a previous podcast of yours, Samuele, the term dry powder. And that's exactly what it is. You have all these firms. The estimate is about $180 billion dedicated for African venture capital and private equity. $180 billion sitting in bank accounts that's not being deployed as they've promised. And so the question is why? Why are they sitting on all that capital? And why are they not deploying it? I think the simple answer is it's easier to just park it in a bank that pays 10%. They take their 2% cut. They are able to pay back their 8%, and they actually make no impactful investment, even though technically the money is sitting in Africa. And so I believe a lot of the firms aren't following their mandate. I believe that they're not genuinely here to help. I think they're setting up these funds using Africa as leverage to get the funding to build a nice cushy life for themselves. And so you see these teams sitting in these fancy offices doing one deal every few years. I mean, it seems a bit ludicrous that's the approach, but unfortunately, that's what I discovered. So Pumapa was set up to challenge that narrative. The other narrative that we wanted to do is to democratize the space, is to make sure that it's not just a game for the elite, high net worth people. It's a game that we can play together, that Africans can invest in African startups, that we don't need funding from outside per se, that we can self-fund if we had the mechanisms to do so.
This is such an important question because there is a lot of discussion. Everybody said those are the grow markets. Somebody also discussed the emerging, but the grow market, the future market, the population. But then there is a lot of talk and sometimes no action, and that you have witnessed from behind the scene when you were and discussing with the big companies and the big private equity. And it's so important that as a Kenyan, you are not a spectator, but a protagonist of this movement. And to understand more the why, because when you say that, they are sitting on the money, from your experience and your knowledge of the context for Kenya and Africa, which are the challenges and also the opportunity that you see that startups and the business face in these sort of areas?
Well, I think going back to exactly that, I mean, maybe it's helpful to first define, if I may, the private equity world and the venture capital world.
Fantastic. That is also an important part.
Sure. Yeah. So that we can then understand the challenges and opportunities. So private equity in a nutshell is buying shares in private companies that are not listed, whether they be large, whether they be startups, but it's effectively buying ownership in a company privately. And that's the definition. So what are the challenges? Well, again, so private equity, when you buy a share, you got to remember it's not debt. So you're not actually lending the money to somebody with an expectation of getting it back. You're investing in the belief that that firm will grow and that your portfolio, your investment will grow with it. And eventually you'll be able to get paid things such as dividends, which are payments out of the profits, and maybe and be able to sell your shares at a significant profit later in the future. So that essentially means it's a longer term game, not like a stock market where everything, easily accessible. It's a longer term game, which I think the financial world has made long term seem risky. And I think it's on purpose. I think it's a trick to fool the masses that short term is the way, that taking small returns is safe. But I would argue that that's the opposite, is that short term returns are not safe. They don't grow your money quickly enough. So unless you're already ultra wealthy, it's not going to make any significant impact on your portfolio, especially as you look at retirement, university, buying a house. You can't do that with the short-term investment strategies that the banks and other investment firms are constantly selling us. And the reason for that is you got to remember that the private equity world, 93% of the world's billionaires are made in that world. The other 7% are in real estate. Out of the 93%, 60% are entrepreneurs. So that means the remaining 33% are the investors in those firms. So I don't know personally one billionaire that's been made making short-term investments. The reason I don't know any because they don't exist. So the question lies, why? Why don't people invest in the most lucrative sector in the world that has been for the last several hundred years? Why is it that we're not opening those gates for people? And I think the simple answer is because the world doesn't want it to happen. The elite high net worth 1% don't want it to happen because they want people to be sitting at their desks working for them. A portion of it, it's a portion of many other things, but I think fundamentally you got to remember an entrepreneurial world is not for everybody anyway. So there's naturally always going to be people that will just be the investor. But why restrict people from just being invested? Why can't I sit at my desk, work for you, and invest in your company? Why is there a restriction for that? So those are the questions that Pumapa has to answer. So those, when you take it now as that bigger scale, that it's a very restrictive investment category globally for the most part. We're talking about in the average ticket size being a $250,000 investment for an individual to get involved. In the US, you're looking probably more like $2.5 billion investment. So that means the amount of money that these firms are raising is quite significant. And so they tend to overlook the startups because they want bigger tickets, they want bigger deals, they want an easier way to deploy capital. So to your question, challenges and opportunities. The challenge is access to capital. Founders in Africa, I remember reading somewhere, are expected to deliver 10 times the value on 1/10 the budget. And so they expect an African founder to perform miracles where a founder in the United States will have 10 times the budget to deliver 1/10 the value. So it's the opposite. So underfunding African firms is a big issue and a challenge. You have political interference, which, I don't think I can get into in any depth because I think it's a fairly easy to observe structure in in a lot of emerging markets, a lack of access. And then you have a lack of access to guidance with local knowledge. So you have a lot of consultants that maybe come and offer support from abroad for local startups. But the challenge is some of these people have never done any business in Africa and they don't understand the landscape. And so you may be offering advice, which I think we've talked about in the past, is knowing when to accept good advice and knowing when advice is bad. And sometimes it's hard to differentiate the two. Now, the opportunities, I think Africa is a limitless opportunity. It's probably one of the major reasons why access to funding is quite high, because Africa has 65% of the world's unused arable land. It has large-scale unused water resources. It's a simpler access to market, a lot less regulatory environment as some of the more established countries. And on top of that, you have a very youthful continent with over 50% of the population being under the age of 18. So you're talking about a huge wave of growth that's going to be taking place in the next 10, 20 years within the continent. So anyone who's tapping into and genuinely wants to solve problems for the continent, there's a massive opportunity to do it. But I think that there's going to be a lot of opposition to that. And I think you're seeing examples of that in the Burkina Faso, Niger, Mali regions, where certain governments are able to extract resources for 30 cents, where the market value is $200. And so there's been a huge proponent of exploitation within the continent. So these are some of the opportunities and challenges that are being faced.
And thank you. I think Nick, it's such an important part. I want to go a bit deeper on that. So now, having said that, of course, we have discussed even with other guests the importance, the growth, the everything, but how we do it in there, because how we pass from the talk, the potential to the other. And I think Pumapa was a bit created, as you say, to solve this problem. So how do you support businesses to overcome the challenges and really tackle these opportunities, especially what you said, the access of funding, the disbursement request on African founders, for example?
I think it's primarily bringing access to capital and bringing access to opportunities for investors and making sure that we can include a lot more people within that field. So instead of having, let's say, a $250,000 minimum ticket, what if one were to bring it down to $1,000? That means a lot more people can play. It means you have a lot more investment capital flowing towards these startups of, smaller scale, but that's okay because that's what they need. They're not looking for $250 million. They're looking for 250,000, maybe 20,000, maybe 50. And so you're able to, in a way, bring communities together of investors that have never been able to access this market in the past. And so what we've found from our own numbers is that 50% of our investors are actually overseas. A lot of them never been to Africa. It's interesting because that just shows you that even within their own countries, Canada, the United States, UK, wherever they're living, they don't have access to any of this stuff. And so for them, this is their first time to get into the venture capital private equity world. And so it's an exciting space. And I think where Pumapa can also help is through local support, is the other 50% being local investors. And we want to, drastically increase those numbers over time using technology.
And this is such an important part because, of course, it helps what the missing middle. So sometimes, as you said, the ticket, the 250, $500,000, while from the grassroots level, having worked on entrepreneurship at the grassroots level, you don't have the capacity to reach and also to absorb that kind of ticket. And I want to ask this: how do you select, the startups? Every time I go to the conference and discussion, there is also the thing when there is investments in Africa, it is we are doing good while we are also doing well. That is the discussion that is put there. So is it really possible to balance this tension between commercial viability and really have social and maybe environmental impact in your experience?
Absolutely. Doing good while making profits is very possible. There's no reason you can't. I think they go hand in hand. It's as a natural process for any investment project. I think it's just a question of patience. What do I consider good growth? What is versus what somebody else considers good growth? But I think any business that's growing successfully over time is going to grow significantly and do good. So I'll give a case in point of a company like Amazon, where your traditional private equity investment firms are looking for a 5 to 7 year exit. So they'll invest, buy some shares in a company, and try to exit it to another firm or through an IPO, a listing on the stock exchange within 5 to 7 years. So let's say I'm an investor in that, and I say, "Oh, wow, yeah, we invested in Amazon, and we made 10 times our what we invested. So I invested $1 million, I have 10 million now. Wow, I did great." So maybe one person's measure of the traditional world would say that was fantastic. If you waited 15 years for Amazon, how much would that $1 million be worth today? For me, it comes down to a matter of patience. I think oftentimes the traditional investment strategies oftentimes miss the biggest growth. And so founders need patience. They need time to develop their ideas. They need time to develop their concepts. And if we're constantly rushing a founder and pushing them to exit, maybe we encourage actually less growth. And so I think for us, the way I look at it is we look for companies that are supporting the bottom of the pyramid. We're looking for firms that are tackling basic human needs because those never disappear. And I understand that there can be massive growth and exponential growth in AI and in cryptocurrencies, and the list goes on. But I think in Africa right now, the fundamentals are what's needed because AI isn't going to feed 1 billion people. AI isn't going to house 1 billion people. AI isn't going to provide medical care. It's not going to provide, it's going to be used in all of these industries. But you need those industries to be there in the first place. So I think that's how you do good, is the companies that are solving problems for the people and making a profit while doing so. Because a company that's not making a profit won't survive. So they have to go hand in hand. I think it's now a choice of whether you want to do good or not. So I think most people tend to want to look for companies that are doing good and making a profit because they go hand in hand. We look for companies that have a non-linear growth opportunity. That, to give you an example, if I plant 1 acre of seed, that acre will yield me 10 acres of seed. And so that's a non-linear type of growth where your outputs are greatly different than your inputs. So when you can exponentially grow your business with the same inputs, it shows a non-linear growth. And so we're looking for companies that have strategies of that nature. And when we see that they're kind of tackling fundamental challenges, that they have good growth opportunities to do good and be profitable, we then fundamentally have to look and make our decision based on the founders, the people behind the company. Do they possess the essentials of what we think make a solid founder? Grit is one of the things that we predominantly look for. And that is effectively passion, perseverance, and purpose. So if the founder is able to demonstrate to us that they have those 3 things, then we believe that they're able to pull off what they're doing with their company with the right funding and support. Then that's how we select companies.
And that is very important because, of course, the traditional metrics sometimes for this type of businesses may fail. So you have also to look at the human and also the problem that is solved. And pushing on that, I want really to ask this question. Can you share some examples of companies that you have invested in and showcase which problems they are trying to solve and how they are doing it in this non-linear way?
I think I'll just share maybe one company for now in the essence of time, but I'd say all of the companies we're working with are doing this in their own way. There's a company called Forest Foods that we're working with. Now, they're working in a agricultural system called syntropic agroforestry. And to really highlight it, you got to look at the world data around farming, water resources, and what's happening within the world. And the actual crisis that's coming, well, that's already here, the silent crisis that's already here, which is there's not enough in let's call it the more developed regions, parts of Asia, North America, Europe, Middle East, they don't necessarily have the water resources anymore to continue feeding their populations. And so they're going to have to start looking at new solutions. What I love about what Forest Foods is doing is that they're tackling this problem. You see, Africa is not really facing that challenge at the moment, other than North Africa, Egypt, Morocco, Libya. Those countries have more of a water crisis. But the sub-Saharan Africa, there's really no water crisis at all. But in order for us to preserve it, we have to find solutions that are going to utilize the fact that Africa is on the equator, the fact that Africa has good weather year round, and the fact that we're going to have a large population of people to be feeding. And we can't, to be honest, think about it. Let's just play out a scenario. If China or the United States ran out of water, would they be exporting food to Africa? No. So what would Africa do? And that's the problem. You got countries like the DRC importing 93% of its food, yet they have one of the most fertile growing regions. They could be a net exporter, significant net exporter of food, had they had the right resources and investments made into their agricultural sectors. So going on to now the Forest Foods example, what do? They're building farming solutions that mimic natural forests. They're effectively recreating the Amazon rainforest, which more and more scientific studies starting to show that the Amazon was actually a carefully cultivated agroforest, entropic agroforest from thousands of years ago. And it's still here today, producing food. And I think that's exactly what Africa needs right now, is we need food solutions, food systems that will survive thousands of years. But it has to start somewhere. And so they have a regenerative, sustainable, scalable system with an excellent team utilizing technology with the implementation in the future with AI. And this is going to help not only their firm do well, but it's going to help them train others how to do exactly what they're doing and to be building this ecosystem, not only in Kenya, but throughout Africa. So I feel here's an example of a company that not only is this good, after about 4 years, they no longer have to irrigate. So irrigation switches off. After that, water tables start getting restored. They're increasing the carbon content within the soils. So they're having high carbon sequestration. They're having very good soil management systems that will be more fertile than pretty much any farm you'll find in the world that's not practicing these systems. You're going to have a sustainable long-term food solution. You're going to have sustainable long-term timber solutions. But a system like this just takes time. So it takes that investor who looks at it more like an Amazon. That's not going to try and say, oh, we need to get out after 5 years. No, it's going to take a longer-term investor who's going to say, this is not only going to benefit me in retirement, but it's going to benefit my grandchildren, my great-grandchildren, as a very long-term planning solution. And I think that's what more and more investors have to be thinking about, is stop thinking short-term and start thinking long-term, because I think that's where significant change could be made.
And it's such an important example because it's really not preaching but doing what many people that discuss regeneration, soil, and work. So it's actually and again is not tackled by the traditional way. Also, what I in my experience I'm doing through the not for profit, but on a for profit basis, which is also an important part.
Well, and sorry, Samuele,
and especially if you see the report, for example, from the Soil World and other organizations saying that also in Kenya there is depletion of soil. So we really need regeneration rather than the traditional farming. And it's really this example really puts together then the profit and the doing good and solving a problem that is touching the lives, not only here in Kenya, but it can be a transformative example for many countries. However, we also be aware that the world of startup is not only roses. No, sometimes it's difficult, there's failures and others. So going a bit and tapping on your extensive experience in the continent and your portfolio of startups. So I want to ask, what advice or lessons that you have seen that founders and investors might need to want to know before engaging these areas?
There's an example I like to use is people fear failure, but it's not. Does a 2-year-old fear failure. In fact, through failure is how they learn. It's how they grow. It's how they hone their skills. It's how they learn how to walk, how to crawl, how to sit, how to eat. It's how they learn how to read, how to write. By drawing scribbles on a paper turns into letters as those skills are honed. Failure is not something that should be. Now this goes for both investors and founders. Is that just because something failed doesn't mean you give up on the strategy. It means you just keep learning and you keep growing and you keep making decisions, but you don't stop. The only thing I can say, or the key lessons that I've learned for founders and investors, be patient, don't quit, and be consistent. Those 3 things have shown significant value over the 15 years that I've been in the industry. The people that do those 3 things have been wildly successful. Those that aren't patient, they quit. Because quitting is really what failure is. That's when it stops. Failure is just a lesson. Quitting is when it actually stops. So, don't fear failure, fear quitting.
And this is important because, of course, you have to be a long game, as you said. And if I can stress a point that you've said many times, it's investing and private equity is not for the short-term returns, but it's for a long and transformational journey. I'm sure that our listenership is all over the world, but also we have a good listenership here in Africa in many of these emerging or grow markets. If from your experience, which are the advice and maybe the mistakes that you have seen within this year that founders and entrepreneurs do, and how to avoid them?
I mean, it goes back to grit. It goes back to that patience, perseverance, passion, and purpose. So it goes back to grit. I think the majority of the founders that fail lack the grit to succeed. Not for any bad reason. I'm not saying that they're bad people or that they're failures. No, it's just perhaps the problem that they were tackling wasn't something they were passionate about. Perhaps, sometimes you'll have somebody who thinks, oh, I could do that. So they go open a restaurant and then they realize they have no passion to do restaurant business. And that's okay. I mean, that's all part of that failure, right? It's now a question of how do they stand up and do something that they are passionate about? How do they go and find the business that they can find that grit for themselves? And so sometimes you have a lot of firms that are started by people who aren't entirely sure about what they're doing and are doing it more because they think they can make money out of it rather than doing it because it's something that is a fundamental belief of theirs. And I think so, when we look for firms where people have that as a fundamental belief rather than it being a way for them to make money. So I think fundamentally grit being probably one of the biggest mistakes, company structure. So even though you have a firm that possesses or a founder that possesses that grit, they may, in an effort to not be alone, take on a few partners. And so they start a business with a few of their friends. And let's say they share their equity 3 ways. The unfortunate thing that happens there is that 2 of the partners won't do anything, typically. And you'll only have the 1 person. But because they gave away 2/3 of the company, they can't effectively run the company anymore. And so the business will collapse as a result of the other 2 partners not pulling their weight. And that's very common. What I would advise to a lot of founders is, it's great if you want to start a business with others, but you don't need to give them much equity. Let them earn it over time, hold the majority of those shares, 95%, but make sure you're holding the majority of those shares while you start, because you're going to need space to bring on equity investors if you're going that route. You're going to need space to bring on advisors, to bring on key partners. Just because you don't want to start it alone, you can start it with others, but if you're the one who's going to be doing all the work, make sure you're the majority shareholder. So I would say it's those tend to be a lot of the reasons I've seen firms fail. Access to capital has been one, and so I know you mentioned 3, but I'll just throw one more in, is also scaling correctly. Once you get a bit of money, it doesn't mean you go and buy the fancy car and you get the big office and you hire the 100 staff. I've seen so many firms that have raised $30 million collapse. And there's no reason they should have. They needed maybe 5 million to pull off their plan. So how did they collapse with a 30 million injection? So sometimes it's management as well.
And those are such important and to the point. Also we say maybe stay humble and also focus on the mission, because sometimes, easy money and burning, money is sometimes easy. Another point I want to ask, you mentioned at the beginning that Pumapa is focused on democratization of the investment access. We had some other discussion with other people from the private equity, which strongly disagree with that, saying, democratization, smaller investors, it is a risky word, tickets should be big because it's a risky word. So from your discussion, Pumapa has taken a different road to that. So can you give us a bit why you have decided, to democratize access to the private equity and the private market asset, which usually is the realms of the rich or ultra net people rather than the common inches we say here in Kenya, and how also you have leveraged maybe technology and other tools to really, put action from your word democratization into action and really giving access, especially to local and indigenous people, to they want to invest in the transformation of their own countries.
Probably, and I've faced this question many times. I think in the beginning, a lot of people said to me, I think democratization won't work. It's, you have to manage so many small investors, too many questions. And I said, well, I think it's also about the journey you take them on, though. I think the traditional private equity world, transparency is lacking. And so when you're not transparent, you see it's difficult to convince a lot of smaller investors who will be asking a lot of questions. And so for me, if you're not, and I'm not saying that they're not transparent to be deceptive. I'm saying that's just the nature of the way that their business is done. Because a traditional private equity will say, we're going to raise $100 million for African startups. So they go and raise 100 million. Then is when they make the investments into those companies. So it's after they've already received the money that people start to learn where they're investing. We do it the other way around, is that people get to select which companies they want to go into. They make their decision. As we provide a journey and a portfolio for them, it's not that we're advising them, it's that we're opening up opportunities. We're opening up, let's call it a shop that people can come and make their decisions. I think more and more of the world is shifting that way through digital platforms. You have things like eToro or international investments in crypto world, as well as in the stock markets globally, as just an example, but you have many other firms doing that. So I think it's this traditional approach to investing meeting an innovative approach to investing, where there's going to be resistance for one reason or another. But I think for us, the way we seek to manage it is through transparency, through people making their decisions. We're merely let's call it in a very simple way, we're merely a shopkeeper, and we're providing products on the shelves for people to go shop and make their choices. So we provide, we try to give them as much due diligence as possible. We try to do as much insights into a company and allow people have access to read that information and make their decision in an informed way. The reason I think this is, I think when we took that approach, we took a big risk, but we've invested in 10 companies, 2 have collapsed, 3 are profitable, and the others are looking like they're going to be making profits within the next year or 2. So has it been a success? Absolutely. So the question is how do we keep replicating that, and how do we encourage others to be a part of that ecosystem? Because now I'm sure you've also heard of this from the other private equity side. So they say democratization of the venture capital private equity world doesn't seem to make sense. But then you go and ask them the same question. Well, how are your exits? How are your exits? And their exits will be the exact opposite story. Say, well, we really struggle with our exits. We really, really struggle, because they have this very limited time window where they have to perform on their fund. They have to get out within 5 to 7 years. Investors are expecting it. Our approach is we don't know when you're going to get out. It could be a year from now. It could be 10 years. It could be 20 years. But for the most part, by providing that democratization process, we can build in a secondary market solution, which allows people to stay in as long or as short as they want, as long as there's other buyers willing to purchase those shares from them. Now, that creates the opportunity for people to stay or leave. And this is a big problem that most of the PE firms are facing, is that they don't know how to exit. For us, it's not really I don't really think about exits that much. Not until as a portfolio, which we ultimately can make a decision on. Once the portfolio makes a decision to leave, then fine, all of the exits will take place. But we won't make a decision like that lightly. We'll make it when it makes the most sense for all the investors within that portfolio. But for the most part, while we're still holding the portfolio, people are able to enter, exit. People who maybe were a bit too shy to invest at the very beginning of a company while it was still a piece of paper have seen the growth of a company take place over 4 years and say, well, maybe we can pick up some of those shares now that that company is profitable. It's still young enough. We're still getting early, but we didn't want to take that risk so soon. So I would argue that I think there's a massive opportunity for the space, but I think it really depends on from which viewpoint are you looking. Are you looking at a viewpoint from outside in, or are you looking from internal? Now, I would say the internal viewpoint of the African view is that we have to look at how to democratize the space.
And it's such an important thing. And you also tackle one of the points that sometimes it's critical for the emerging market, but also for the private equity world, the liquidity, how to exit, and of course for African startups and the let's say the infancy of many stock markets that we have in the region. Of course, IPO, or we're not in the Silicon Valley, there is no Nasdaq or other. So this secondary market really helps democratize and also have an exit for people that are also local and maybe they want also to work. So we could also be a part of a building, of the culture of the market that maybe sometimes is lacking, isn't it, Nick?
Yeah, I mean, my understanding is there's only 13 stock exchanges in Africa. Yeah, there's 54 countries. So the traditional approach, I would question it for an African perspective because it doesn't address the fundamentals. And we already know $180 billion is sitting in bank accounts doing nothing. We also know that there's nearly $2 trillion in exits that haven't taken place that should have. So yeah, I think innovation is where we stand. We stand with trying things in a different way. Does it take longer? Same as forest foods. It's a growing process, it's a building process. But eventually we find an ecosystem that's sustainable, that regenerates, that encourages local investment for local firms. And I think, it may not work for everybody, and that's okay. The traditional approach will be just fine. Same thing as farming. It's, right now, traditional farming's needed to feed the world. But I think as more and more systems and solutions change, we can find a more vibrant marketplace that is more inclusive.
And as we are approaching the end of the interview, it's such a been let's say an opening, an eye opener also for me to understand and go the nitty and gritty on how really to put the words into action, especially to put sustainable businesses in the continent. I would like to ask you, what is the vision for Pumapa maybe in the next few years? You are a fairly young also fund. I think 2018 you have started. So how, from the milestone already you mentioned 10 company, 3 are profitable, other let's say 6 are moving towards that direction. So where do you want to take Pumapa and which is your vision maybe for the next 5 and 10 years?
First step would be to create a vibrant marketplace. A vibrant marketplace for entrepreneurs, for investors, for even other venture firms, for other private equity firms that are looking to find exits or are looking to share information to, maybe tap into local knowledge. So I think a vibrant marketplace will be critical over the next 5 years to continue our growth and expansion. But then overall, our strategy is to just keep looking for some outstanding young startups, maybe work with some larger firms that have had the right, but have gone wrong somewhere along the way. You're talking about some old firms that have a good market share would be a huge loss for an ecosystem, but are just needing the right advice. And so I think, as we build our marketplace and our market systems, we're going to be able to also start supporting larger firms that do have a large impact, that have hit key milestones, but are maybe just either through a lack of succession planning or a lack of management systems have fallen behind a little bit, that just need a leg up again to get themselves back to where they need to be. So I think there's a lot of opportunity to continue working with startups. I would love to have 100 startups under our portfolio in the next 10 years. I think one of the journeys for investors is for investors to start thinking about it as a collection, where people are investing in different startups. They're taking a 10-year approach to it. They invest in maybe 5 startups a year, 3 startups a year, and they do that for the rest of their lives. Historically, I don't see anyone not being absolutely amazed by how their portfolio does. If you have 40, 50, 100 companies in your portfolio, all startups, yeah, you only really need just a handful to do extremely well. You just need one Amazon, one Tesla. So the whole idea, that's why I said I go back to being consistent, patient, and not quitting. So just because you invested in one startup, great start, but don't stop. And that's why the ecosystem, our marketplace, is so important, is to make it as easy for people to be involved and to stay continually engaged and involved.
And I would say we'd also be critical, at this rate, to solve the problems for what has been also termed the African century and the need for entrepreneurship, solving the huge unemployment crisis. So 40 and 50, it seems a big number, but it's actually, I think, the minimum required. So I really loved the episode, and also thank you, Nick, for sharing your wisdom and your insights from behind the scenes. Let's say you have opened up the window of this secret world of private equity and told us also the opportunities and challenges and your innovative approach, especially for our area, our Africa, which really needs, transformation and innovation. So it's been a pleasure and honor hosting you. Thank you so much, Nick.
Thank you, Samuele. It's my pleasure as well.
Are you satisfied after this wonderful episode? Let's continue together our sustainability journey.